Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Radian Group Inc. Annual Report. Radian Group Inc. offers a wide range of businesses and services in the mortgage and real estate industry. The company's primary focus is on aggregating, managing, and distributing U.S. mortgage credit risk through private mortgage insurance on residential first lien mortgage loans. In addition to its core business, Radian provides various other services including title services such as insurance and non-insurance titles, tax and title data, centralized recording, document retrieval, and default curative title services. The company also offers mortgage underwriting and processing, escrow, appraisal management, and real estate brokerage services. Furthermore, Radian provides real estate valuation products and services, asset management for managing real estate-owned properties, and a suite of real estate technology products and services, including proprietary platforms as a service solution. These services cater to various clients such as mortgage originators, consumers, mortgage lenders, investors, and government-sponsored enterprises. Overall, Radian Group Inc.'s diverse range of businesses and services make it a comprehensive provider in the mortgage and real estate industry. Radian Group Inc.'s stock price has seen a slight increase of 1.05% over the past year, driven by several significant news events. One key factor was the company's strong fourth quarter and full year 2025 financial results. Radian reported an adjusted operating income of $1.16 per share, surpassing estimates and beating expectations in both earnings and revenue growth. The acquisition of Inigo, a Lloyd's specialty insurer, for $1.67 billion is another major contributor to the stock price increase. This strategic move has transformed Radian into a global multi-line specialty insurance provider, with projected annual revenues doubling and accretive earnings per share. These positive developments have instilled investor confidence, leading to an appreciation in stock value. The combination of these events has created a positive sentiment around Radian Group Inc., contributing to periods where its stock price increased, including potentially surpassing 5.19% in specific trading sessions or short periods. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be categorized into several key areas. Net premiums earned and net investment income are common drivers that significantly impact revenue. Other income, such as interest and dividends, also contributes to revenue growth or decline. Industry-specific drivers include the performance of the mortgage insurance segment and revenue from discontinued operations. Financial statement analysis reveals various items that contribute to revenue growth or decline, including policy acquisition costs, provision for losses, other operating expenses, interest expense, and changes in cash flows. Investment-related drivers also play a crucial role, with net investment income and gains/losses on investments affecting revenue. Other drivers include unrealized capital losses, decreases in state and local NOL carryforwards, and increases in statutory contingency reserves. Understanding these drivers is essential for analyzing the financial performance of an organization and identifying areas for improvement. The net income of Radian Group has experienced fluctuations over the years. From 2023 to 2024, there was an increase of $84.439 million, 12.7%, in net income from continuing operations, resulting in a net income per share increase of $0.07, 1.8%. However, this trend reversed in 2025, with a decrease of $42.14 million, 6.3%, in net income from continuing operations and a corresponding decrease of $0.18, 4.2%, in net income per share. The profit margins have also shown a decline. The loss ratio increased from -4.6% in 2023 to -0.2% in 2024, before rising to 7.1% in 2025. Meanwhile, the expense ratio decreased from 29.1% in 2023 to 27.9% in 2024, but then rose to 27.7% in 2025. The net income margin from continuing operations also showed fluctuations, ranging from 50.5% to 52.1% in 2025. The overall trend indicates a decrease in both net income and profit margins over the years. The reasons for this decline are not explicitly stated, but it is likely due to various factors such as changes in market conditions, increased competition, or operational inefficiencies. The company's operating cash flow status is a subject of inconsistency in the provided summaries. On one hand, certain pages indicate positive operating cash flow for 2025, with amounts ranging from $340,791,000 to $719,987,000. However, other pages contradict this information, showing negative operating cash flow for the same year. The discrepancies suggest that the company's financial performance is not as clear-cut as it seems. While some sections of the report indicate a healthy inflow of operating cash, others reveal a significant outflow. This inconsistency raises questions about the accuracy and reliability of the data presented in the summaries. As a result, it is difficult to determine with certainty whether the company is generating positive or negative operating cash flow for 2025. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the total debt level increased from $5,841 million in 2024 to $6,129 million in 2025, indicating an upward trend. However, a closer look at the data reveals that the increase is relatively small, with a slight rise of $2,571 from December 31, 2024 to December 31, 2025. Breaking down the debt level further, we see that senior notes increased by $2,571, while other borrowings decreased. This suggests that the company has been focusing on refinancing its debt and reducing its reliance on short-term borrowings. The interest expenses have also seen a significant decrease, dropping from $88,006 in 2024 to $68,290 in 2025. This reduction is attributed to various factors, including the Inigo acquisition, which increased the company's debt level, but also led to lower interest expenses. The overall trend suggests that while the company's debt level has increased, its interest expenses have decreased significantly. This indicates a shift towards more efficient debt management and reduced financial burdens on the company. The performance of Inigo's various segments has been mixed. On the positive side, specialty insurance has shown attractive profitability and excellent underwriting performance. However, other regions and segments have struggled. The Inigo region itself has faced challenges due to unforeseen liabilities, rating actions, and potential failure to realize anticipated benefits. Additionally, the mortgage conduit, title and real estate services businesses are experiencing difficulties, including potential inability to complete divestiture transactions, disruption of current plans and operations, exposure to unanticipated liabilities, and separation of operations. These poorly performing regions and segments pose significant challenges for Inigo's overall performance. The management of the company is signaling a cautious approach to its outlook and strategy. The slowdown in revenue growth in 2025 indicates that the company is facing challenges in maintaining its previous pace of expansion. However, the acquisition of Inigo represents a strategic step towards becoming a global diversified insurer, suggesting that the company is committed to long-term growth. The company's focus on fundamental operating activities and adjusted pre-tax operating income as its primary measure of financial performance indicates a desire to strip away non-core items and focus on core business operations. The use of reinsurance arrangements to manage risk and the emphasis on managing market risk through sensitivity analyses and stress tests demonstrate a commitment to prudent risk management. The company's plans to divest certain businesses, such as mortgage conduit, title and real estate services, by end of Q3 2026 suggests that it is adapting to changing market conditions and focusing on core competencies. Overall, the management's message is one of caution and adaptability in the face of a challenging business environment. The company has made several strategic moves through acquisitions and divestitures to restructure its business. On the acquisition front, the company has purchased Inigo for $1.65 billion, as well as mortgage loans and related assets through master repurchase agreements. Additionally, it has acquired Inigo Managing Agent Limited and Lloyd's Syndicate, Syndicate 1301. In terms of divestitures, the company has sold off several businesses to streamline its operations. The mortgage conduit business, title business, and real estate services business have all been divested. Furthermore, Radian's mortgage conduit business was also sold, along with certain other immaterial businesses. A business held for sale is estimated to be worth $207 million as of December 31, 2024. These moves are likely aimed at optimizing the company's portfolio and improving its overall performance. The company has demonstrated its commitment to returning value to shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out significant amounts in 2024 and 2025, with totals exceeding $300 million over these 2 years. Furthermore, the company has a substantial dividend requirement for the next 12 months, indicating that it will continue to prioritize dividend payments. In addition to dividend payments, the company has also engaged in share buybacks. In 2024, it repurchased approximately 7 million shares at a total cost of $224 million, and in 2025, it repurchased over 13 million shares for around $430 million. These significant investments in share buybacks demonstrate the company's confidence in its future prospects and its desire to reduce the number of outstanding shares on the market. Concerns about inventory buildup and supply chain disruption are prevalent in the current economic landscape. One major concern is the accumulation of excess inventory, particularly mortgage assets. As noted on page 59, there is a risk that companies may be forced to hold and finance larger than anticipated inventories of these assets. Furthermore, data from December 31, 2023 shows an increase in default inventory, with numbers rising from 22,021 to 25,230 by the end of 2025. This trend suggests that companies are struggling to manage their inventory levels effectively. Supply chain disruptions also pose a significant threat. The secondary markets for mortgages and residential mortgage-backed securities may experience significant disruption or illiquidity, leading to delayed access to deposits or other financial assets. Additionally, counterparties and customers may struggle to meet their obligations, exacerbating the problem. These issues have the potential to disrupt the entire mortgage market, highlighting the need for companies to develop strategies to mitigate these risks. That concludes the financial summary for Radian Group Inc. Feel free to comment below, and I will be happy to answer them when possible.